Serious topic today. Is the market going to crash? You see it everywhere. Every post, everything. If you're looking to buy a house or looking to sell your house, everyone's always talking about, is this the right time to sell? Are you going to lose money? Sell before it's too late. Today, we're going to be addressing the real problem and what our opinions and expertise would be on the topic. First question, why do people still think the market is about to crash?
Gabriel, I've been hearing that the market is going to crash since about 2014, maybe 2015. There's always negativity in the market, right? And it usually comes from people that can't afford to buy a house or had a problem or, just don't understand how market dynamics work, right? And if you say something like that long enough and often enough, eventually you may be right, But so far, the market has disproven it's going to crash any day now for a long time. And I think one of the things that a lot of people are confused about is they saw the crash from 2008, right? We experienced a pretty horrible real estate crash, but that and the Great Depression were the only times that we've had serious depreciation of real estate assets. All of the other recessions that we've ever had, for the most part, real estate has either stayed flat or gone up. So it takes a big event to ruin the real estate market the way 2008 did. And that was a big event.
So what is the actual difference between now and 2008? Obviously, we had a huge event happen in 2020.
Yeah.
And people thought that was the end of real estate. And boy, were they wrong.
They were wrong, completely opposite.
Yeah, now it's impossible to buy a house anywhere close to the prices that you would get prior to 2020.
Absolutely, yeah. So the biggest difference between 2008 and today is an act that was done by Congress that isn't perfect, but it really did straighten out a lot of the problems that the mortgage industry created. And that's the Dodd-Frank Act. So what that did was it forced mortgage companies to strengthen the standards by which people get approved for mortgages. Prior to 2008, all they needed was a name and a mirror. They put the mirror under your nose, and if you fogged it, you got a loan. And I'm not kidding. They had loans, they called them ninja loans. It's a no income, no job, get a loan, right? I mean, they were just giving away money. And it was ridiculous. It's obviously unsustainable. It can't happen. It was one of the reasons that real estate prices rose from about 2002 to 2006 or 7 as much as they did. It spurred overbuilding by builders, right? So the builders were, 5 builders, big tract builders were looking at one area and said, we need 3,000 homes. So they each built 3,000 homes. Well, now you have 15,000 homes, you only needed 3. So there was a lot of overbuilding, and that when the mortgages started to not come through, people on those loans that were adjustable rate or had balloons in them and those kind of things, when they started defaulting, the whole thing kind of collapsed like a deck of cards, like a house of cards, right? And when that happened, all the builders were just giving away homes. They were going bankrupt. They were stopping complete projects. And it took about 7 to 8 years, depending on the area that you're in, for the real estate market to actually even normalize.
Wow. It definitely takes a lot of moving parts for things to go wrong. A lot of people and a lot of industries are interconnected. I think that's something that gets understated a lot.
Sure.
With the real estate, like the contractor industry is part of the real estate industry. When you think about your building materials,
Sure.
The stock markets are going to be involved, life insurance is involved, all these different things. So it takes everyone kind of tanking to tank that.
For sure. Real estate is a huge part of our overall economy, right? People think it's just a place to live, and it's a place to live, but people invest in real estate, people improve real estate, people build real estate. It's an ever growing need. And so, it's a huge impact. And when real estate goes bad, the whole market goes bad.
So speaking of the market, right now, what would you say the latest numbers in Central Florida really say about what direction we're heading this year for
Right. So yeah, so now in 2025, right, the the real estate market in Florida is very, and it always is, but it's very local, right? So we're here in Central Florida. We don't operate mostly on the coasts, right? We kind of go out to the coast, but we don't really do a lot out there. In our part of the counties, we're relatively stable. Houses are selling in a reasonable period of time if priced correctly, maybe 60, 90 days. We have less than 6 months of supply, which is right at a balanced market. Where you see the strain on the market is in condominiums, because there's some new legislation that Florida put down that is putting a lot of strain on condominium associations and the people that live in them. There's a lot of money being spent on structural integrity studies and things like that. And big assessments are happening. There's people that are getting, $10,000 assessments, which are absorbable, but there's people getting $50,000 and $100,000 assessments on their building. And that's kind of hard to absorb, especially if you're on a lower income. So you're seeing a lot of the condos, especially beachside condos, that are really getting impacted. I mean, I'm seeing values drop from 400,000 to 200,000. And those kind of impacts, but we're not seeing that in the single family home market, definitely not in interior to Florida.
Got it. So we spoke a little bit about inventory, that we're at mostly a balanced market.
Yeah.
I know we were at a low inventory for a while.
Yeah.
Why does low inventory, high inventory, and balanced markets, why do they matter?
Well, they matter because it's all about choice. And it's all about leverage and negotiations, right? So if there's 50 people looking for houses and there's 5 for sale, a lot of people are going to be disappointed, right? And the 5 people that do buy are going to probably pay more than they would have had to if there wasn't as much competition.
Makes sense.
Right? That's your supply versus your demand. If you switch that, right, which puts you in a severe buyer's market, if there's 50 houses for sale and only 5 people looking at them, they have their choice.
Yeah.
And they can push and negotiate, right? And the sellers at some point are going to break and give in to those negotiations. So that's where prices get pushed back down. A balanced market is where everybody kind of wins and kind of loses together, right? We're just like, we're trading at a fair market value and there's no real input. Maybe there's 25 people looking in 25 houses. So maybe everybody doesn't get exactly what they want, but they get something.
Okay, that makes sense. So it sounds like we're not necessarily headed towards a crash. So who benefits from all of this crash talk?
It's mostly media driven. I mean, there's 2 things that sell in the media. One is sex and the other is fear, right? And this is all about fear. And when they talk about doom and gloom, people pay attention. And it's not that they want it to happen. It's just it grabs attention. You see the feel-good story about the kid that was, given a new heart. It's like, yeah, cool, right? But you see the fear of like, oh my gosh, these horrible things are going to happen. You pay attention because it might impact you. And so, I think it's really all about being driven by the media overall. And then there's some people that just buy into it and reflect it.
And that's why it's so important to be informed properly. If you are thinking of buying, selling, or investing anywhere in Florida or around the country, and you want to get some information that is non-biased and some expertise from us, we have a QR code on the screen now for our Sunshine State Handbook. It has plenty of information for you to find out a bunch of this kind of information. It's evergreen and can help you with your choices and how you want to make them yourselves. No fear, none of that stuff. Just pure facts. So next question.
Sure.
Are we in a correction, a slowdown, or a long-term growth cycle, would you say?
For right now, I feel like we're in a correction.
Okay.
I'm seeing houses, seeing a lot of price cuts on houses. That is mostly coming from people that try to sell a little bit too high because they want to negotiate down, right? Or they still think it's 2021 or 2021 or 2022 where they have all the power and they don't. So there's some of that going on. And then people are giving a lot more concessions than they used to, right? They're willing to pay some of the buyers' closing costs and things like that. So we're not seeing a lot of appreciation. Now that changes by market, and by market I can mean within a few miles of each other, right? We were looking at some markets, yeah.
Yeah.
I recently working in Sanford, we're getting a lot of push down on price, right, and having to give more. And when we look in Winter Springs, which is not far away, just on the other side of a lake, we're seeing houses sell for a full price or even more. And selling quickly.
With competitive offers.
With competitive offers. So, you know, and they're very similar markets. They're not that different, but they're different enough that those things are being impacted.
Makes sense. Mm-hmm. Absolutely. So what should buyers be doing instead of waiting for a crash? Like what is the play here? Because it's obviously not wait for the house to tank to $100,000. That's $500,000.
Sure.
What should they be doing?
Yeah, I mean, you know, it's a good time as a buyer right now because there are a lot more sellers in the market trying to sell their homes, and they are sitting on the market longer. So number one, as always, and this is no matter what the market is, what I'm about to say is always true, is have your credit together. Have a good credit score. You have to have a good credit score unless you have a lot of cash. Because having a low score, you can still get approved, but it's going to cost you more money. You're going to pay a higher rate. Mm-hmm. You know, so if you can get your credit score above 720 or better yet, even over 740, that's where you start heading into the really top tier rates, and you're going to get the best there. Have a significant down payment. Be ready for that down payment, right? Because again, the more you put down, the less PMI you're going to pay, right? Which is private mortgage insurance. And private mortgage insurance only protects the bank. All that is insurance money that goes into a pool in case people default, and then the banks get a little bit reimbursed, right, for their losses. So there's a cost there. So the more you put down, the less PMI you're going to pay. The better your credit score, the less PMI you're going to pay. It's all kind of factored in there somehow. I don't work in that side of it, so I couldn't tell you the formulas, but they're definitely, I can see the impacts. And then, you know, the other thing is be flexible and be patient when you're ready to buy. So by be flexible, I mean, you know, you have a lot of wants and needs. Make sure you meet the needs and then discuss the wants, because you might be able to get a better deal 3 blocks over, and maybe you're giving up that one little thing that you would have wanted, but maybe you save 50 grand because that buyer or that seller is ready to go, right? They're more willing to negotiate. So be prepared for that and be patient in that you're not going to find that on the first house you look at, the second house you look at, the third house you look at. But if you look at enough and ask enough questions, you'll find that deal. And there are deals out there.
And definitely prioritize. I always tell our buyers that we work with, prioritize the things that you cannot change. If you want a fireplace, but the house doesn't have a fireplace, you can always go to, you know, IKEA and get one of those fake fireplaces and kind of have the same thing going for you. But if you want to be close to your job, you can't just pick up the house and move it 10 cities away. Yeah. So definitely focus on the things that you can't be changed later on.
Absolutely.
So what's the risk of waiting for too long to act now that we're in that correction market?
Yeah, I mean, again, I don't think we're in a long-term correction market. So I think if you're ready to buy, buy. If you're not ready to buy, and by that I mean you don't have the down payment, your credit's not good, all those other things, then fix those things. That's where the patience comes in. But you know, the sitting on the sidelines, if you are ready and not buying because you're waiting for something bad to happen, isn't going to help you. Yeah. So I would say, you know, when you're ready to buy, go buy a house. Down the road, 2, 3, 5 years, you can always refinance that loan. You can pull some equity out and do some improvements that you wanted to do, or just get yourself a better rate. Those are choices that you can make. But house prices in general are going to increase year over year. Every year, it may not happen on schedule, but over 5 years, they're always going to improve. Over 10 years, they're always going to improve.
And at the end of the day, whatever experts you're working with, whether you're doing this alone or whether you're working with a whole team of people, people know people. We always refer our loan partners to our clients that we're working with. Absolutely. If you're not ready, they will tell you they don't want to risk their money as much, but they also want to make sure that they're getting loans out there. That is the business that they have. Mm-hmm. So they want to put you in the right position. So if you have any questions on that, if you're in the Central Florida area, reach out to us. We're happy to connect you with one of our loan partners. But we didn't touch on one person, I don't think, of our normal demographic of buying, selling, and investing. Tom, you're an investor. Let's give a one last tip for the investors. Are investors still buying in this market? And what are the profitability to buy when you're saying it? Prices just keep rising.
They do. And, so here in Central Florida specifically, we had a lot of time where rents increased along with house prices. It's currently decoupled a bit. So when I first started investing, which was only 11 years ago, you could buy a house and pretty easily get our 1% rule, right? So the 1% rule means that whatever you buy it for, you can get about 1% of that as rent. So you could buy, a $60,000, $70,000 house and get $700 or $800 a month out of it and meet that criteria. And that was a good investment. Now you're looking at $300,000 houses and you're maybe getting $2,200 or $2,300 in rent, which is not anywhere near 1%. And depending on how you're buying, if you're heavily leveraged, you may actually have negative cash flow. Now, I know investors that buy negative cash flow. They don't mind that for various reasons. Maybe they have a lot of other properties that are giving them cash flow, and so they don't mind a little offset because they're looking for long-term appreciation. Some of them might be looking for tax deductions. There's various reasons to do that, but most people aren't going to be doing that, right? Most investors are going to want to look for something that at least pays the bills, if not provides a reasonable return on their money. And that's where the issue is with investors right now in Central Florida. So unless you're finding a deal, unless you're finding a desperate homeowner, you're finding a dilapidated property, or you're buying lots and building. I've seen a lot of investors switch to that. It's a really tough investor market. As a matter of fact, this is anecdotal, but a lot of the investors that I know are selling their rental properties to homeowners. They're selling them to homeowners because investors won't pay them enough, but homeowners will. So we're actually seeing, in my opinion, a time where the investor space is getting cleared out a little bit and it's shifting more towards homeowners. Now, that's a generalization and that's anecdotal because it's how I see it. It's the people that I deal with. But I definitely see that as a trend. I mean, I've probably sold 60 rental properties in the last 2 years that are no longer rental properties.
Wow. Well, that's been a lot of great information. It's positive news to hear that we're probably not going to be crashing anytime soon.
Probably not.
If you did find this information helpful, please make sure to hit that like button, hit subscribe, and click the notification bell on the screen to make sure that you're always staying up to date with the videos we put out. We put a video out every single Sunday. I've been Gabriel Burgos.
And I am always Tom McNamara.
And this has been the Florida Real Estate Insider Podcast. We will see you next month.